Hello everyone. So today we are here to present on Ind AS 108 operating segments. In today's business environment, most large organization operates across multiple products, services, geographies, and customer markets. So as a result, looking only at the consolidated financial statements often does not provide a complete picture of how different parts of the businesses are performing. Ind AS 108 addresses this need by requiring entities to disclose financial information about their key business segments. The purpose of the segment reporting is to help users of financial statements to understand which business activities drive revenues and profitability, how management allocates resources, where risk and opportunities exist, and how performance differs across the products and geographical markets. So to ensure a structured and logical flow, we have created the full deck. So we'll start with the agenda and move forward. So let's move to the first slide, which is the agenda slide. Okay, so this is the first agenda slide, and what we are going to talk in the agenda is we are going to talk about the objective and scope of Ind AS 108. We'll talk about the key definitions, and then we'll try to figure out that how the identification of operating segments are done. What is the concept of aggregation of segments? What is reportable segment, and what is the difference between the operating segment and the reportable segment? What is 75% external revenue rule? Segment disclosures, and then how we have to measure the segment information. We'll also touch base upon the entity-wide disclosure, and we'll try to create a comparative analysis between the entity-wide disclosure versus segment disclosure. We'll look at some of the key reconciliations that are required to be done as a part of Ind AS 108. And then finally, we'll conclude this session by giving a quick snapshot of what differences, if any, between Ind AS 108 versus IFRS 8. So we'll move to the first slide. Okay, so first slide, which is the objective and scope, we'll quickly touch base on the objective and the scope slide. So objective of Ind AS 108 is to prescribe the principles for reporting the financial information about an entity's reporting operating segments, products and services, geographical areas, and major customers. So while all these are the requirement which includes the mandatory reporting, operating segments we'll look at the definition of operating segment in upcoming slide. Product and services are the key product and services, and these are required mandatory disclosure, which is an entity-wide disclosure, geographical areas, and the major customer. So core objective is to enable the user of the financial statement to evaluate the nature and the financial effect of the business activity in which entity engages and the economic environment in which it operates. So objective here is to get the users acquainted with the fact that if at all the entity is having the multiple products and multiple services and multiple geographies, how each geography or each segment of the business are performing, and they can evaluate that which segment is performing better and which segment needs attention by the management. So to that it can add the value to the overall consolidated profits. So India's 108 focuses on the management approach, specifically when reporting is concerned. Segments are reported based on the internal reports reviewed by the management. So segment reporting has to be again dependent upon the internal management. Ind AS does not prescribe any method, but it prescribes a certain key reconciliation that needs to be created. So when we talk about the scope here, so it applies to entities who's listed and who's listed or in the process of being listed. So well, largely it applies to all the entities which are on which Ind AS is applicable. So segment information is required in the consolidated financial statement and in separate financial statement if consolidated are not presented. So typically, objective and scope are clear in terms of giving the impact of the segment revenue of which are the operating segment of the entity, and then making sure that they should be properly disclosing the reconciliation, and there are certain specific segment disclosure versus entity-wide disclosure that needs to be disclosed so that users of the financial statements are clear and they can evaluate the performance of the segment. So we'll move to the next slide, which is the key definition slide. Now we'll touch base on some of the key definitions which are required to be understood for the Ind AS 108. So operating segment. So operating segment means the component earning revenue and incurring expenses reviewed by the CODM. CODM is the chief operating decision maker team that takes the decision about the performance of the operating segment. So example is telecom division of a conglomerate. When we talk about CODM, so person or the group allocating the resources and assessing the performance of the operating segment. For example, CEO and the managing committee, which decides how the company, how this particular segment is performing. Concept of reportable segment. So segment meeting the quantitative threshold. So we'll talk about this in the upcoming slide. What is the definition of the reporting segment? For example, retail segment with 15% is treated as a reporting segment. This is the quantitative rule. Segment assets are the assets used by the segment if reported internally, and machines for manufacturing. And likewise, segment liabilities are the liabilities allocated to the segment if reported. So these are a key definition that needs to be understood as we proceed further, because we are going to use these terms, specifically reportable segment and the operating segment, quite often, and the definition should be clear and kept in mind while we are discussing about this in the upcoming slides. So we'll move to the next slide. Okay, now we have understood the concept of the operating segment. The next thing is that how we have to identify those operating segments. So identification of operating segment is largely a business-driven decision. A segment qualifies an operating segment if it engages in the business activity, earning the revenue, incurring the expenses, results reviewed regularly by the CODM, and discrete financial and the information is available. So any segment for which the business activities are being measured by evaluating the performance in terms of revenue being generated and the expenses being incurred, results being reviewed by the committee, which is comprises of the CEO and the managing committee, and then we have the concrete and discrete specific financial information for that particular segment. So these are like normally a quick kind of a categorization. This is which the entity chooses the operating segment. So example are, let's say entities having a manufacturing plants for the steel, cement, and power. So these three are treated as the operating segment because these are engaging into different set of the business activity, which is earning the revenue and the incurring expenses. They are being reviewed regularly to evaluate the performance of each of the business segment, and then definitely the information is clearly available and identifiable information is available to evaluate the financial performance. So the CODM reviews each separately, all are the operating segments. That is most important. So if review of the CODM is done to make sure that they evaluate the performance of each segment, then those are largely identified as the operating segment for an entity. So we'll move to the next slide. Okay. Now, sometime it is also important for the entity to ensure that the kind of the information that they have and the impact that is going to have on the overall revenue. So they can then club few of these segments together, and then instead of reporting each segment separately, they can report two or more segment by aggregating them. So two or more operating segments may be combined if they have the similar nature of the product and services, production process, customer type, distribution method, and the regulatory environment. So, which means that it is a discretion that is available to the entity. They want to add up few of their reporting segment if they have multiple reporting segment, and to have the concise and the meaningful reporting, and making sure that the impact is not going to give a kind of a non-transparent information, but making sure that the aggregation is giving a consolidated view, and that consolidated view, if it would be given separately, that is not going to impact materially the reporting purposes. So if at all by showing separately, it is having a material information that needs to be disclosed separately, then it has to be disclosed separately. But by aggregating, that materiality is not going to get lost, then they can take that step and do the aggregation. But it again depends on the management discretion. But at the same time, it has to be ensured that by aggregating, they are not hiding any concrete information that otherwise would have been disclosed if the entities would not have done the aggregation of the reporting aggregation of the operating segments. So example, North India retail plus South India retail may be aggregated if the similar economies exist. So depend upon the kind of the operating environment which an entity is operating. Aggregation is required if these conditions are met, and discretion is on the management. But at the same time, to make the judicious call, they have to make sure that they are not hiding any information which otherwise needs to be reported if those were reported in the separate operating segment. So we'll move to the next slide. Okay, now we'll talk about another key aspect of Ind AS 108, which is the reportable segments. While operating segment are largely driven by the management discretion, wherein they have the segment which is having the reporting for which they are calculating the revenue, cost, and then they have the allocatable assets and liabilities, and their financial information for that particular segment is discretely available. The reportable segment is driven by a rule here, so which is the quantitative rule. So segment becomes reportable segment if it meets any of these conditions. So there are three tests: revenue test, profit and loss test, and the asset test. So revenue test is segment revenue is more than or equal to 10% of the total revenue. Profit and loss, segment profit or loss is more than 10% of more than or equal to 10% of the greater of the total profit of the profitable segments, or total loss for the loss making segments. And the asset test, this segment asset is greater than or equal to 10% of the total segment assets. So, for example, if total revenue is 1000 crore, segment revenue is 150 crore, and 150 crore is greater than 100 crore, which is 10% of 1000, then this would be treated as a reportable segment. Now, question normally comes into mind that what is the difference between the reportable segment and the operating segment? So it has to be clear like this. So first of all, we have to identify the operating segment. Once the operating segment has been identified, then we have to classify the reporting segment out of it. Not every operating segment can be a reportable segment if it is not falling under the limit of the 10% here. So which means that identification of the operating segment is at the top, and then we have to identify the reporting segment basis the threshold that has been defined and prescribed in the Ind AS 108. So, basis operating segment meaning is that component and revenue driven by the CODM. Reportable segment, operating segment disclosed separately. Stage is so operating segment is being identified at the identification stage. Reportable segment is identified at the reporting stage. Number can be many. It can be many because we have as many discrete information available at segment level as entity wants. But reportable segment would be fewer because it is based upon the threshold limit. Threshold is no quantity threshold for the operating segment. There's a threshold of must meet 10% or 75% rule. So we'll talk about the 75% rule in the next slide. So disclosure requirement is not always disclosed, and it must be disclosed if it is like breaches. So if it is a reportable segment, it has to be disclosed. It has now form because it has actually exceeded the limit which has been prescribed as per the standard, and purposes for internal management analysis, and reportable segment is largely for the external financial report. So this makes very clear that what is the difference between operating segment and the reportable segment, and also operating segment is prima facie the most important thing that entity has to do, and then they have to calculate the threshold, and then they have to carve out the reportable segment out of those operating segments. So we'll move to the next slide, which talks about the 75% rule. Okay, now we'll talk about the 75% external revenue rule. So what does this mean? So this is very critical and very important to ensure that the users of the financial statement should have all the transparent information. And then it has to make sure that the total reporting segment should cover 75% of the external revenue. Because otherwise, if this would not have been there, then people or the entities try to hide their non-reporting segment under the others, which is like hiding the critical information. So Ind AS 108 requires that the total external revenue of all the reporting segment must be constitute at least 75% of the entity's total external revenue. So it means that once they have identified the reporting segment, then post that they have to also evaluate whether those reporting segment actually constitute 75% of the total revenue. And if not, then they have to add few more segments to it to make sure that that constitutes the 75%. And even that, even though that particular segment is not reportable segment, still that needs to be added just to make sure that they comply with this 75% rule. This ensures that segment information disclosed covers the majority of the entity's business activities. The 75% rule prevents the entity from reporting only a few segments and leaving the large portion revenue under the others. So, which means that if this rule would not have been there, they can entity may at its discretion take only some few of the reportable segment basis the threshold limit and then report the numbers, while the less percentage of a lower percentage of reportable segment is constituting the larger percentage of the external revenue that would not get reported, because if this limit is not there, then they are at liberty to report only for the reportable segment. But with this rule, they are abide to make sure that the total reportable segment revenue should constitute 75% of the external revenue, and if not, they have to add more. They have to add more reportable segments. So this is to ensure the better transparency, better comparability, and meaningful segment reporting. So how does this work? So we have illustrated stepwise approach that how does this work. So first of all, we have to identify the operating segments. So once we have identified the operating segment, we have to apply 10% quantitative rule, which we have discussed in the last slide, previous slide. Then we have to determine the reportable segment. So first we identified the operating segment, then we have to apply the threshold rule of 10% to identify the reportable segment. Then we have to check if the reportable segment totally covers the 75% or more of the external revenue or not. If the total reportable segments total revenue include exceeds or equal to 75% of the external revenue, then it is sufficient. But if not, what they have to do? If not, include additional segment until 70% reach. And this additional segment may not necessarily be the reportable segment. This is the threshold approach. Now, couple of points needs to be clear here that the threshold rule which is applies for the reportable segment is 10%, and when 75% is the 75% coverage rule. We have to be very much sure that what kind of revenue needs to be considered here. So for 10% revenue threshold, both external and the internal segment revenue needs to be included. So that if at all a segment is having a 50% revenue from the external customer and 50% revenue, 50% of from the internal segment, but that 100% actually add up to 10% threshold, then that segment is treated as the reportable segment. But for 75% coverage rule, we have to consider only external revenue only, and then we have to exclude the segment revenue. So which means that there can be a situation wherein the reportable segment total revenue is more than 10%. This is the threshold limit of 10%. But when we'll try to apply that rule over the total revenue or external customer revenue, its total revenue is, let's say, only contributing 5%. So in which case, then we have to identify more segments to be included to make sure that we adhere to the 75% rule. So intercompany revenue is included in determining whether an operating segment meets the qualitative threshold for reportability. However, the 75% rule is applied only for the reference to the external revenue, and inter-segment revenues are excluded. So this is very, very critical, and it's a very tricky as well, because both rules run independently, and 75% external revenue rule is superseding rule over the reporting rule. So even if reporting entities have been identified, reportable entities are there, still if it is not meeting the total 75% rule, then we have to add more reporting segment to achieve this 75% external revenue rule. So we'll move to the next slide then. Okay, now we have discussed what is operating segment, we have discussed what is reporting segment, we have also understood the concept of aggregation, we also understood the qualitative 10% approach and the 75% rule. Now we'll talk about the segment reporting. So what are the key specifics that needs to be report as a part of the segment disclosure? Because this is largely a segment operating segment standard. So each reportable segment here must disclose the revenue from the external customer, inter-segment revenue, segment profit and the loss, segment asset and liability, depreciation and amortization, interest income, capital expenditure, and the material items or the income and expenditures. So all these are mandatory disclosures that needs to be done for a reportable segment. So quick example here, for example, we have three segments: retail, manufacturing, and then last one is others, which may be again depending upon the total revenue, it may be not breaching the 10% limit. So revenues are there, profits are there, and the assets are there. So we have to disclose all this information just to make sure that we have proper segment disclosure at there for the reportable segment. So we'll move to the next slide. Okay, now we'll talk about the measurement of the segment information. While Ind AS 108 itself does not prescribe any measurement criteria to evaluate the performance of the segment, because the operating segments and the reportable segments are largely driven by the management reporting, which is internal management reporting. So Ind AS 108 does not prescribe any uniform measurement basis. So how to evaluate the performances, this depend upon how entity or the CODM of that particular entity requires the performance to be measured. So which means that they can evaluate the performance basis the EBITDA or the operating margin or the profit before tax or the contribution margin. Uh, and we know that because segment reportings are largely done for the segment purpose, and it excludes some of the information which otherwise would have been deducted if the entity is taken as a whole, which means that there are certain exclusion of the corporate overheads, exclusion of the finance costs, exclusion of the income tax. So all these are excluded. So which means that profitability at the segment level is maybe somewhat distorted versus when it is being reported at the consolidated level, because it is only concentrated on the segment performance, and hence it is mandatory for the entity to provide the reconciliation, which is the mandatory requirement for Ind AS 108. And we'll look at that reconciliation in the next slide. So, which means upcoming slide. So, which means that measurement criteria is not being defined in Ind AS 108 because it is largely driven by the management discretion that how they want to evaluate the performance of their reportable segments. So, we'll move to the next slide. Okay, now we'll talk about entity-wide disclosures. So while we have discussed that there are certain segment-specific disclosure which are required as a part of Ind AS 108, so there are certain entity-wide disclosures which are required, which are mandatory. So even if one segment exists, entity must disclose what? Product and the services, revenue from the major product lines, example FMCG soaps 40% and the beverages 60%, geographical areas, revenue split by the domestic and the international, and the major customer. If revenue from the one customer is greater than or equal to 10%, disclose dependence, not customer name. So which means that even though there is a single reportable segment, still it entity has to disclose the geographical wise breakup if they are operating from the multiple geographies, products and the services if they have multiple products and services, and then also the major customer. And we have also kind of brought up the differences between the segment disclosure and entity-wide disclosure. While segment-wide disclosures are based on the reportable reporting segment, operating segment, entity-wide disclosures are required for the entity as a whole. Segment disclosures are CODM and the internal reporting driven. Entity-wide disclosures are mandatory even if CODM doesn't review it. Focus on the segment profit and asset liability, while entity-wide disclosure focus on the products, geography, and the major customers. For segment disclosures, only for the reportable segment, entity-wide disclosures are required even if only one segment exists. So which means that entity-wide disclosures have perspective of ensuring that entity must disclose this information as a minimum information whenever they are doing the segment reporting, which is like split between the products and services, split between the geographies, and split between the major customers. And this is the requirement for the Ind AS 108. So we'll move to the next slide. Okay, now we talked about the specific measurement principle and then how it has to be measured, and we have to make sure that whenever we are measuring the segment profit or revenue, it has a certain item which are not normally considered because these are like corporate overheads and the income tax. So then what we have to do, we have to make sure that we have to perform the reconciliation, and these are mandatory reconciliation. So segment revenue, total revenue, segment profit, entity profit, segment assets, and then segment liabilities. For example, this is a quick reconciliation of the profit, which is total segment profit is 200. We have to deduct the corporate overheads, finance costs, and the profit before tax at the end. So this has to be disclosed separately so that users of financial statement could able to interpret that how the total segment revenue is adding up to the total profitability at the entity level. And similarly, we have to disclose the segment assets reconciliation, segment liability reconciliation, and the segment revenue reconciliation. Now we are going to come to the final slide, which is the differences, if any, between the IFRS 8. So we'll move to the final slide. Okay, so Ind AS 108 is largely same with IFRS 8 and largely it is converged. So there are no differences as such. So which means that IFRS 8 and Ind AS 8 108 are absolutely aligned. So with this, we have come to the final slide. We are going to move to the thank you slide, and we'll also have a quick synopsis of what we have discussed in this presentation. So we move to the final slide. Okay, so that brings us to the conclusion of today's session on Ind AS 108 operating segments. So we have seen how segments reporting enhances transparency by showing business performances to the management lens, helping users understand the key drivers of revenue, profitability, and risk across different parts of an entity. We also discussed the identification of the operating and reportable segments. We also discussed the differences between the operating segment and reportable segment, the application of the quantitative threshold, including 75% external revenue rule, and the importance of meaningful segment disclosure and the reconciliation. So Ind AS 108 ensures that financial statements provide not just consolidated numbers, but also valuable insights into how the business is actually managed and evaluated. So I would like to thank all the viewers and the subscribers for your time and attention. And if you have any question, you can paste your question in the comment section, and I'll try to answer all of them. And we are going to come with a new standard very soon. So thank you for watching this video and have a good day.